Good evening, sir.
Oh, the governor.
How has been your day, sir?
I will thank God.
You are welcome.
All
I
right.
don't know, I don't know where our people run to. We never
I
see
just
them.
only ha 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 ha. All right, our class tonight is on budget. We shall be looking at how to prepare budget. The budget to be prepared depends on the nature of the company's business. We have functional budgets, otherwise known as operational budget. We have the functional budget, otherwise known as the operational budget. Under the functional budget, we explained that you have your production budget. Sorry, yeah, of course, your production budget. Your production budget is prepared to show the quantity the company is planning to produce at a future period. Your production budget is prepared to show the quantity we are planning to produce at future period. Your production budget will start from your planned sales plus desired closing stock of finished goods minus opening stock of finished goods. That will give you production budget before rejects. Then you now add anticipated rejects, if any. You add the anticipated rejects, if any. We explained that rejects, these are items produced that is below standard. Some substandard outputs will be thrown into the rejection bin. Only standard outputs will be available for sales. That is production budget. We also have raw material purchase budget. Your raw material purchase budget is prepared from the production budget. You are going to start with your planned production, then multiply by material required per unit. That will give you total material usage, total material required for usage, total material for production. Then add your desired closing stock of raw material. Then less your opening stock of raw material. That will give you material purchase before wastage. Then add anticipated material wastage, if any. Some question, examiner will say no wastage. Some examiner will say there is wastage. We explained this last week. We also look at fixed budgets. That is the original budget. That is the budget that the company originally planned to achieve. This budget, the fixed budget, is not expected to change. We now look at the flexible budget. Budget that is designed to accommodate changes in circumstances. Flexible budgets become necessary because budget is prepared based on assumption and estimates. Flexible budget becomes necessary because the original budget is prepared based on assumptions and estimates. There is the possibility of errors in your estimates. There is the possibility that assumption can change. For this reason, we now prepare flexible budgets. A budget prepared prior to the budget year that can accommodate changes in circumstances. We explained this last week. We also explained flex budget. We said flex budget is prepared at the end of the financial year, where you are giving the actual results. The flex budget will be prepared at financial year end. Excuse me, please. When you are giving, when you have gotten the actual results, your flex budget is based on actual production and sales. But you are going to use the budgeted revenue and the budgeted cost to flex your actual production and actual sales. And we explained that flexing a budget is essentially variance analysis. We also discuss cash budgets, profit and loss budgets, and budgeted statement of financial position. Your profit and loss budget and budgeted balance sheets are regarded as the final budget. Your profit and loss budget and your budgeted statement of financial position are regarded as the final budget. That is the end of your budget production or budget preparation. Your budgeted profit and loss will tell us the profit the company is expected to achieve at the end of the financial year. All right, tonight we shall be put, please can you mute? Except you can control the speaker in your house. Tonight we shall be starting with question 2. Question number 2. On your study text, ABC Limited. Please let us refer to this question. That should be on page 2. Please, we are encouraged to open this question and follow the reading. The exam is 4 weeks now ahead. All right, I'm assuming we have opened the question. We can go on with the reading. ABC is a manufacturing company which makes product Zeta. The budgeted monthly production and sales are 200,000 units. A standard cost has been estimated on the basis of direct cost of 7 naira of material. In brackets, look at the bracket. 2 kg at 3 naira 50 kobo per kg. Let us explain this. That 7 naira direct material cost is the material cost per unit. And it is derived as to produce 1 unit, we require 2 kg of material. The price per kg is 3 naira 50 kobo. If you multiply 2 kg by 3 naira 50 kobo, that will give you 7 naira per unit. That is how material cost per unit is derived. And direct cost of 6 naira for wages. Direct naira, and is calculated as half an hour at 12 naira per. To produce 1 unit, labor require half hour. That is 30 minutes. Half hour is 0.5 hour. Labor rate per hour is 12 naira. 0.5 multiplied by 12 naira per hour. That will give you 6 naira per unit. Please, and please, there is difference between cost per unit and cost per hour. Please, there is difference between cost per unit and cost per kg. May God give us a good understanding. Attempt to pick the wrong figure will result in, God forbid, any attempt to pick wrong figure here will automatically result to 0. Let's continue. In addition, variable overhead has been determined at 2 naira per unit. Monthly fixed overhead are 200,000 naira. Please look at paragraph 1. Paragraph 1 contains so many information. Next, monthly sales for the first 5 months of 2015 has been estimated at the monthly sales, estimated sales for January. Actual sales at the end of 2024, 2014 were 190 in November and 220,000 in December. Next, cash received from the sales is based on previous experience and is expected to be received 60% in the month of sales, 25% the following months, 10% 2 months after sales. It is expected that 5% will be irrecoverable, and this will be written off in the month of sales as bad debt. The selling price is 18 naira per unit. Paragraph 3. Creditors for raw material are paid at the end of the month in which they are incurred. Your raw material will be paid for the same month it was incurred. Wages are paid the same month as incurred. Variable overhead are paid 60% in the months in which they are incurred, and 40% in the following months. Fixed overhead include 25,000 naira of depreciation and are paid 1 month after the costs are incurred. At 1st January 2050, creditors for variable and fixed overhead are estimated at 92,000 and 150,000. Respectively. The last paragraph. The company intends to have finished goods, finished stock at the end of each month, equivalent to 15% of the following month budgeted sales. Look at that statement. Finished good at the end of each month will be equal to 15% of the following month's budgeted sales. For raw material stocks, the policy is to have 25% of the following month's production requirements. Stock at 1st January 2015 are estimated as 22,000 units of finished goods and 104,000 kg of raw material. Please note, there is difference between raw material and finished goods. Please note, there is difference between your raw material and your finished goods. For example, a bakery, flour is raw material. Bread is the finished product. With cash assets 1st January. As at 1st January, the balance is estimated to be 13,000. Requirements. Produce for the 3 months. January, February, March. (2050). A production budget in units. Let's start with that. Like I said, we are going to practicalize Z tonight. If I'm to prepare production budget, look at the formats. You have your months, January, February, March. You are going to start with your man sale, your closing stock of finished goods. Minus opening stock of finished goods. You have X here, X here, you add, then this one will minus. This will now give us production budget. Before rejects, then plus anticipated rejects, if any. You now have total production budget. In this question we read, there is no anticipated production. Deliberately try to bring back all right. Monthly sales for the first 5 months of 2015 has been estimated as sales in January 210,000, February 180, March 210, April 220. You pick this figure. Please confirm you can see my screen being shared. Diesel documents. Hello.
Yes, sir. I can see it, sir.
Please. All right. I will pick my monthly sales. For January 210. April 180. March 210. Sorry, February. Please, can you see my spreadsheet, the Excel documents.
No, sir.
Okay, just 1
You can
minute.
see it.
Yeah, it's still load. It's the network.
You can see it now, sir.
Next thing we are doing. Your January estimated sales, 210,000. February 180. March 210. April 220. May 200. You may be wondering, why do we pick April and May? Examiner says we should prepare for just 3 months. The reason is because of the company's inventory policy. We have picked our planned sales. Look at it. We are only going to submit 3. Let me highlight these 3. Only these 3. Let's go on with the class.
Okay, sir.
It just dampens somebody's morale.
Sorry about
All right,
that.
like
Sorry
I
about that.
said, if you are to do production budgets, you are going to start with your planned sales in units. You pick your figure. Then add closing stock of finished goods. Let's go to the question. Look at the last paragraph. Examiner says the company intends to have finished goods at the end of each month, equivalent to 15% of the following month budgeted sales. If you come here now, if you want to get closing stock for January, you are going to calculate 15% of following month budgeted sales. Following month, after January, the following month is February. So you are going to calculate, look at it. Let's go to workings. Working 1. Working 1. Calculation of closing stock of finished goods. I have January. I have February, I have March, I have April. If I want to get closing stock for January, 15% of following month budgeted sales. What did it say in February?
180,000.
180,000. Compute.
27,000.
27,000 units. If you want to get closing stock for February, 15% of following month budgeted sales. The month following February is March. What is the budgeted sales in March?
110,000.
Please compute 15%.
31,500.
31,500. If I want to get for March, 15% of the following month budgeted sales. What is budgeted sales for the following month after March is April? What is budgeted sales for April?
220,000.
Compute 15%.
33,000.
If I want to get for April, examiner says 15% of following month budgeted sales. The following month after April is May. What is the budgeted sales for May?
200,000.
15% will give you 30,000.
30,000.
If you go back to the Excel, look at it. Desired closing stock of finished goods. 27,000 for January, 31,500 for February, 33 for March, for April,
30.
Is that clear, please? Is that clear, please?
Yes.
Yes, sir. Yes, sir. Yes, sir.
Yes, sir.
We now come to opening stock. We come to what? Opening stock. Let's go back to the question. Look at the last paragraph. Stock at 1st January 2015 are estimated to be 22,000 units of finished goods. It is that finished goods that we require now. That means as at 1st of January, opening stock is 22,000. Look at it here. Opening stock of finished goods. Look at this line. As at 1st of January, please just 1 minute, 1 minute. Let me go back here. I want to relax this. I want to increase this, increase. Okay. The figure here is I'm sure it is right. Okay, this is what's causing the problem. It's looking at this as an, let me see. Wow. In just 1 minute. Oh, I will reopen. I'm going to reopen it. Okay. Oh, it is holding me now, oh God, and I want to fasten this thing. Please, just 1 minute. Okay, let me do like this. Let me remove color. Oh my God. Please, let's go back to our document. Something has tampered with what I want to do. And it's failing because I want to save time with this thing tonight. Oh shit. Don't save. Reopen. Where the production budget say?
Maybe sir, you should undo, just undo, and maybe and go back from the beginning.
And this thing has been working before. Something is holding this thing. I see. Don't save anything. Let me do something here. I'm sure it's this pen that is not allowing this thing to move. Maybe just 1 minute. If it's not working the way we want, I have to go back to. I will share now. If it's not going the way I wanted, we might be forced to go back to the Word document.
No problem, sir.
What is the meaning of this today? We're going to see right. As if it's hanging. there command here? Campus figure here. There's something here that is affecting me. There's something here that is affecting this sense here. Oh shit. If I delete this place now,
So I think you can just create another sheet, then copy the whole thing and paste there.
I program this thing. We have a lot of things. Oh shit.
So maybe you should close it, just close it completely and reopen it again.
I've done that severally. I will now come here. Like this. Okay, we have taken this off. Let's revert to this. I don't have that luxury of time. It's just unfortunate. Let's go on to this. Your production budget. Production budgets. The months January, February, March. No, I have to make provision. You have the months January, February, March. We have to make provision for April. You start with your planned sales in January 210, February 180, March 210, April 220. Your closing stock of finished goods. Examiner says 15% of following months budgeted sales. 15% of 180. That gives us 27. 15% of 210. That gives us 31,500. 15% of 220. That gives us 33. If I want to get for April, 15% for May, that gives us 30,000. Next, minus opening stock of finished goods. If you look at the question, finished goods at 1st January, 22,000 units minus it. If you want to get opening stock for February, please look at this. Closing stock for January becomes opening stock for February. Please look at it. In January, our closing stock is 27,000. It was closing for January ending. It becomes opening for February. March opening stock. February closing stock becomes March opening stock, 31,500. Then for April, March closing stock becomes opening stock for April. You can now get your production budget. Let me shift this down small. You can get your production budget now. Look at it, please. 210,000 plus 27,000 minus 22. Please sum up. Please sum up.
215,000.
That means the production for
January.
January, okay, is 215,000. Is that not, please?
Yes, sir.
We go to just 1 minute. This plus this plus this plus this. You should give us 215 now.
Yes, sir. 215,000, sir.
Okay. No, I'm sorry, I'm trying to do something. This should give us this. Why is he seeing this as minus D? Oh, you know. This is equal to this. Just 1 minute. This plus this minus this. All right. Please allow me again. If you work this now, this is 215. If you check this out, you have 184,500. Is that not, please?
Yes, sir.
Check this out, you should have 211,500. Is that not?
Yes, sir.
The last one should give you 217,000. Is that not, please?
Correct, sir.
Now go back to the Excel. Production budget. Can you see the Excel, please?
Yes, I can see, sir.
Oh, it's made. I'll pick it from here. I already put it here. You can see it. For January is 215,000. February 185,500. March 211,500. You are done with your production budgets. You are done with your what? Production budget. Plan sales plus desired closing stock that's set to requirements A. That is set to what? Your requirements A. We now go to
Now we can't hear you.
Daddy, we cannot hear you. Seems the voice is not fine.
purchase
Big.
Network, no favor this month.
Can you hear me now?
Yes, sir.
Yes.
It was network that was. It has made the class to even tire myself. Please confirm you can see my material being shared.
Yes, sir, we can see.
Can see. Hello. Hello.
We can hear you, sir.
The network strength is fluctuating really. All right, let's just try whichever one we can solve. I don't want to use the word unfortunate because next week we are almost rounding up the class. If you are to do purchase budget, you start with your planned production, then multiply by material required per unit. By material required per unit. That will give you total material usage. Plus closing stock of raw material minus opening stock of raw material. Your material usage plus closing stock of raw material minus opening stock of raw material. X, 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 X will give you material purchase budget. Purchase budget before wastage. You are going to get a figure here. Then plus anticipated wastage. Plus anticipated what? Wastage. No, plus, no minus. That will now give you total purchase budget in kg or in units. That means if I want to prepare material purchase budget, I'm going to start with my planned production. Please look at this side. Planned production. Look at the first figure. In January, we are going to please, can you see my Excel? I hope you can see my Excel.
Yes, sir. Yes, sir.
Yes, sir, we can.
Let me expand this more. Let me expand this more. Okay, look at it. You know, I was trying to find a way to improve what we do. Our planned production for January 215,000. February 184,500. March 211,500. April 217. Material required per kg. Let's go back to the question. To produce 1 unit, look at it, please. Look at it. Direct cost of 7 naira of material, 2 kg at 350 per kg. To produce 1 unit, you require 2 kg of raw material. Look at it here. Material required per kg. 2, 2, 2, 2. Multiply. Please get your calculator. 215,000 to produce 1 unit, you require 2 kg. If you now want to produce 215,000, how many kg? Oh yeah.
430,000 kg.
That's how we get 430 here. For February, you are going to produce 184,500 units. And to produce one, you require 2 kg. Multiply, total kg, total material usage.
369,000.
369,000. For March, to produce 1 kg, to produce 1 unit, you require 2 kg. And you are going to produce 211,500 units. Total material usage.
423,000.
123. That's how we get that figure. For April, 217 multiplied by 2 kg. Total kg for production. 434,000
kg.
That is how we get our total material usage in kg. We now go to desired closing stock. Closing stock of raw material. How do we get this? Examiner says, let's go back to that paragraph. Last paragraph. Look at the last paragraph. Look at it, please. For raw material, the policy is to have 25% of the following month production requirements. For raw material closing stock, the policy is 25% of following months production requirements. Go back to the Excel. Closing stock of raw material. If I want to get for January, I will compute 25% of following months material required. Following month after January is February. Total material required for February is 369,000 kg. Please compute 25%. Please compute 25%. The class is silent.
92,250.
Let's go to the work. If the class is silent. Look at the working here. Working 2. Calculation of closing stock of raw material for January. 25% of following month production requirement. Look at it. Total material usage in kg. For February is 430,000. Following February, for January is 430. The month following January, February, is 369,000. I will now compute 369,000. Compute 25%. For February, 25% of following month production requirements. After February, following month is March, 423,000. Please compute. For March, 25% of following months production usage. Following month after March, April, 434,000. Please compute manually.
For January, 92,250.
92,250 kg. Next.
105750.
105. Let me take it off. 105 750. Next.
108,500.
108,500. That is your closing stock. Look at the figure here. This Excel has been, calculation is involved in this, has been programmed with figures. This gives me, now, what is the opening stock of raw material? Back to the question. Look at the last paragraph. Stock at 1st January 2015 are estimated as 22,000 units of finished goods and 104,000 kg of raw material. In this case, opening stock of raw material as at 1st January is 104,000. I can come here. This is equal to 104. Look at it here. Now to get for February opening stock, go and pick January closing stock. The closing stock of raw material in January become the opening stock of raw material in February. To get opening stock for March, the closing stock of February becomes the opening stock in March. You can now get your production budget in kg. You can get your production budget in kg. To do that, you are going to start from material usage, total material required. You can also call this total material required. Total material required. Plus closing stock of raw material minus opening stock of raw material. Please add and subtract. Hello, get your calculator. 430 plus 92,250 minus 104,000. What do you have?
418,250.
Go to February. 369,000 plus 105,750 minus 92,250. What do we have?
382,500.
Do same for March. Total material required for production plus closing stock of raw material minus opening stock of raw material.
425,050.
That will give you your material purchase budget in kg. That will give you your material purchase budget in kg. Yes, Mike.
Yes, sir. So, sir, I have a question for the last paragraph, sir. So now for the closing stock of raw material. For raw material stock, the policy is to have 25% of the following month production requirement. So,
Yeah.
but here now, sir, we're actually using material required. So I'm a bit confused. What's the difference between the production requirement and material required?
It's just English now. Production requirements. Material required for production. You want to produce for the month of January. You want to produce 2,000. You want to produce 215,000 units. Michael, are you there?
Yes, I'm with you, sir.
For the month of January, don't unmute. Thank you for the question. For the month of January, you want to produce 215,000 units. And to produce one, you require 2 kg per unit. So what is your production requirements? Hello.
Yes, sir. So that should be 215 multiplied by 2.
Please multiply what you have.
215.
430.
So we have 430,000.
That is the production requirements material for January. That material needed for production. That material needed for what? Production.
Production, okay.
When you finish with January, move to February. In February, you are planning to produce 184,500. And to produce one, you require 2 kg of material. So what is the total production requirement?
369,000.
That is for February. In March, you have to produce 211,500 units. And to produce one, you require 2 kg of raw material. What is your total production requirement?
423,000.
It's the same thing, whether production usage or production requirement, the same terms. For
Thank you,
April, no, it's okay, because I'm also worried. I'm using Excel for the first time, and the whole intent is to see a way to speed up. Instead of saying plus minus, Excel will have taken it for us, and that will have saved us time. For April, you plan to produce 217,000 units. And to produce one, you require 2 kg. What is your total production requirement?
134,000.
You have gotten that. Now, policy on closing stock. Examiner says for raw material closing stock, the company plans to maintain 25% of the following month's production requirements. That means if I want to get closing stock for January, I will now compute 25% of the following month. Which month follow January?
February, sir.
April. I will now compute 25% of April production requirement material. Compute 25% of 369,000.
92,250.
That becomes closing stock of raw material for January. I will now come to February. Policy says 25% of following month production requirement. The following month is March. March requirement is 423,000. I will now compute 25% of 423,000 kg. Please compute.
105,750, sir.
Good. If I want to get for March, closing stock of raw material, I will now go and check the following months after March. That will take me to April. The total production requirement is 434,000. I will now compute 25% of it.
108,500.
You have gotten your closing stock. So you are going to add it to your total material requirements. Know that material purchase is different from material used for production. Company will have inventory policy. If you require, like we require 430,000 for production, we can't just buy 430. We might require material for inventory as a buffer stock. You now come to your opening stock. Examiner says, as at 1st January, opening stock of raw material is 104,000 kg. We pick that. That is the opening stock for January. Now, what about February? For me to get February, then the closing stock for January automatically become opening stock for February. Is that clear, please?
Yes, sir.
The closing stock for February automatically becomes opening stock for what? March. You can now get your material purchase budget in kg. Total material usage or required plus closing stock of raw material minus opening stock of raw material. That will give you your material purchase budget in kg. Is that clear, sir?
Yes, sir.
Now, when you are done, what is the price of material per kg? Go and check the question. Look at paragraph 1. Material price per kg. Look at 3 naira 50 kobo per kg. We can return to the Excel. In January, we are going to purchase 481,250 kg. And material price per kg is 3 naira 50 kobo. Please multiply. What is the total value of material purchase?
1,463,875.
If you look at your screen, what do you have?
1,463,875. Same thing, sir.
Go to February. You are going to purchase 382,500 kg of material. And the price per kg is 3 naira 50 kobo. Please multiply.
1,338,750.
We move to March. In the month of March, we are going to purchase 425,750 kg. And the price per kg is 3 naira 50 kobo. Please multiply.
1,490,125.
You are done with your material purchase budget. You observe that we didn't bother to color April because examiner says, and we didn't bother to complete April. We don't require April for submission, but we require April and May for our workings because of the company's policy on inventory. The inventory policy says for finished goods, 15% of following month. The following month will be April. For raw material, the policy says 25% of following months. That means we require April for working purposes. You are done with requirements B. Please check requirements C. What are we asked to do?
Cash budget.
Cash budget. What is cash budget? How do we prepare cash budget? Quickly, your cash budget will show your cash inflows and your cash outflows. At the end of the period, you are going to have net cash flows. Your cash budget will show your cash inflows and your cash outflows. At the end of the period, you are going to have net cash flow. Your net cash flow could be positive or negative. If it is positive, it means surplus cash flow, surplus cash. If it is negative, it means cash deficit. In preparing your cash budget is prepared on cash basis. That is, if you make sales, your sales until you collect cash. If you make sales in January and you have to collect cash in February, that cash will be recorded against February. Your purchases, if you make payments, if you incurred costs, until you make payments, if you incur costs, until you make payments, before you can recognize in your cash budget. Now, let us go to the cash budget. Excel is a powerful tool. Let's go to it. Don't worry. Ignore the figures. You have your cash budget for the month of January, February, March. You have your cash inflows, the cash receipts. You have cash outflows. Now, your cash inflow will come from your sales receipts. Let us go to the policy. Look at the policy. Look at paragraph 3. Cash received from the sales is based on previous experience. If you make sales, look at the collection, and it's expected to be received 60% in the month of sales, 25% in the following months, and 10% 2 months later. Look at the policy now. If you make sales, you are going to collect 60% the same month of sales, 25% in the following month. 10% 2 months after sales. It is expected that 5% will be irrecoverable and will be written off in the month of sales as a bad debt. The selling price is 18 naira per unit. Now let's go and compute. Actual sales at the end of 2024, 190 in November, 220 in December. Please look at the workings. Sales in the month of let us go to the first working phase. Our plan says look at it. Sales in January. How many? How many units? Plan says
10.
210. Let me come here. It is wrong. It is equal to, we come back here, 210. Sales in February. How much?
180.
180. I'll pick that. Sales in March. How much?
10.
210. I'll pick that. What about November 2014? What is the sales value? Sales units.
190.
Let's pick that. Just 1 minute. 190. What did it say in December?
220.
Let's pick that figure. What is the selling price per unit?
18 naira.
Look at it. 18 naira, 18 naira, 18 naira, 18 naira. Get your sales value. Quantity multiplied by selling price. Please compute.
$3,420,000.
That will be for November. Go to December, compute.
3,960,000.
Look at your screen. What do you have?
3,960,000.
Go to January, compute. January.
3,780,000.
Good. Go to February, compute.
3,240,000.
Great. Then go to March, compute your sales value.
3,780,000.
Great. You have gotten your sales value November, December, January, November, December 2014, January, February, March 2015. Now, what is the collection pattern? Are you going to collect your money? Please look at this, the collection pattern. In the month of sales, you are going to collect 60%. The month following month, you are going to collect 25%. 2 months after sales, you are going to collect 10%. Examiner says 5% is irrecoverable, and that represents bad debt. Is that clear, please? Is that clear, please?
Yes, sir.
Yes, sir.
Yes, sir.
Now let's go to collection. In the month of November, we sold our sales value 3,420,000. That same month, we are going to collect 60%. Please compute 60% of 3,420,000.
Is 2,052,000.
2,052,000. Look at it here. The month following sales, we are going to collect 25%. In the month of December, which month follow November? Sorry, in the month of November, which month following November?
December, sir.
Now come here. 25% of 3,240,000. Please come.
855,000.
Look at it here, please. You observe that it was placed under December. We are going to collect this money in December. This is our collection. You observe that it was placed where 25% to be collected in December. We are still on November sales. November sales 3,420,000. We collected 60% in November, 25% in December. Then 10% will be collected 2 months after. What is 2 months after November?
That's January, sir.
Compute 10% of 3,420,000.
That's 342,000.
Can you see my console? That
Yes, sir. Yes,
takes
sir.
me to January. Look at it. 1, 2, 3. You now come to December. In December, you made a sales of 3,960,000. 60%. Please compute 60% of 3,960,000. Please compute 60% of 3,960,000.
2,376,000.
Look at this, 2,376,000. It was placed under December. The following month, you are going to get 25% of December sales. That will take you to January. Is that not, please?
Yes, sir.
Please compute 25% of 3,960,000.
990,000.
If you check January, you see in January, you have 990,000. Then 10% will be collected 2 months after sales. The sales you make in December, you are going to get 10% 2 months after. That will take us to where?
February.
February. If you compute 10%, that will give you 396,000. You are done with what? We now come to January. In January, you made a sales of 3,780,000. That same January, you are going to collect 60%. Please compute.
2,268,000.
If you check first month, under January, you have the figure there. A month later, you are going to collect 25%. That means the January sales, a month will take us to February. For our January sales, how much?
45,000.
945,000. Look at it under February. Then 2 months later, you are going to get 10% of January sales.
78.
378. That will take you to March. 2 months later, 2 months after January, that will take us to March. You are done with your collection. These are collections. You now come to February. February, you made a sales of 3,240,000. That same February, you are going to collect 60%. Please calculate.
Sir, can you come again, sir?
Okay, I said in February, you made a sales of 3,240,000.
240, yes,
Is that
sir.
not?
Yes, sir.
Is that not?
It is.
And policy says in the month of sales, you are going to collect 60%. Please compute 60% of that sales.
1,944,000.
Can you see it, please?
Yes, sir.
It was placed under February collection. These are collections. Let me even remove this. Let me do all this. Please, just 1 minute. Let me make it plain safe. All these are collections. Collection, collection, collections, collections, collections. Remove this pattern. Collection. They are all collections. Collections. It is the amount collected that matters under cash budget. That means in the month of February, we collected 1,494,944. The following month, you are going to get 25%. The following month after February, that following month will take us to March. Compute 25% of 3,240,000.
810,000.
Look at it. We place it under March. Then 2 months later, you are going to collect 10% of February sales. What is the 10%?
$324,000, sir.
You are going to collect it 2 months after. 2 months after February, we take out to when?
April.
April. They are not doing April budget. You forget about that. We now move to March. In the month of March, you sold 3,780,000. And you are going to collect that same month of March. You are going to collect 60%. Compete, what do you have?
2,268,000.
That is the figure you are having here. Examiner says 5% of your sales is irrecoverable. 5%. And this will be written off in the month of sales. If you compute 5%, 5% of 3,420,000. That will give you 171. If you compute 5% of 3,960,000, what do you have?
198,000.
January says 5% of this is irrecoverable. Compute.
189,000.
February says 5% is irrecoverable. Bad debt to be written off.
$162,000.
And if you go to the last month, March says 5% is irrecoverable and will be written off. 189. Look at your sales receipts. We are only concerned with January, February, March. Your collection, 1, 2, 3. You don't add bad debt to it. 1, 2, 3. Sum up. These 3. Look at the collection. In the month of January, cash collected from sales, 3,600,000. In the month of February, cash collected from sales, 3,285,000. Is that clear, please?
Yes, sir.
In the month of March, our collection, bad debt is not part of your collection. So you are only going to add 1, 2, 3. That will now go to your cash inflow. Look at the figure here. Automatically coming here. Cash receipts in January, 3.6. February, March. You are done with your cash collection. That is the cash inflows. We can now go to the cash outflows. Let us go back to the question. Your cash outflows, your payments. Look at the next paragraph. Creditors for raw material are paid at the end of the month in which they are incurred. What is the amount incurred on raw material? Go and look at your purchase budget. Look at the purchase budget. In the month of January, we are going to incur for material purchase 1,463,875. Examiner says the creditors will be paid the same month it is incurred. That means we are going to pay cash out for 1,463,000. In the month of February, we are going to pay cash out for the purchase of raw material. In the month of March, we are going to pay 1,490,000. 125. In the month of March, go and check your cash budget. Look at the payments. Payments for raw material. 1, 2, 3. Next, payment for labor wages. Let's go and check. Wages are paid the same month as incurred. What is the labor wages? Per unit is 6 naira. Look at it here, please. Please look at it. Direct cost of 6 naira for wages. In brackets, half an hour at 12 naira per hour. Labor wages per unit is 6 naira. How many are we going to produce in January, February, March? Go and check your production budget. Look at the production budget. In the month of January, we are going to produce 215,000. February, 184,500. March, 211,500. And labor cost per unit is 6 naira. Per unit produced, we pay labor 6 naira per unit. So if you produce in January, you produce 215,000 units. What is the total labor wages? Hello. Hello.
It is going to be 215,000 times 6 to get the production.
Now look at it. Look at the working year. Total labor wages paid. 215 multiplied by 6 naira. 1,290,000. 184,500 multiplied by 6 naira. 1,107,000. In March, we are going to produce 211,500 multiplied by 6. 1,269,000. Go and check your cash budget. Look at the figure here. Automatically populating. 1, 2, 3. Next, variable overhead payment. Examiner says variable overhead has been determined at 2 naira per unit. I will come here. And I'm going to produce, look at it here. Working number 3, variable overhead incurred. In the month of January, we are going to produce 215,000. February, 184,500. March, 211,500. Examiner says variable overhead cost per unit, 2 naira. That means total variable overhead in January, 215 multiplied by 2 naira. What do you have?
430,000.
430,000. That is the total variable overhead cost incurred in January. February, 184,500 multiplied by 2.
$369,000.
That March multiply. You have gotten the variable overhead incurred. This is different from variable overhead paid in cash. You have gotten the variable overhead incurred, but you cannot take everything to your cash budget. What is the amount paid in cash? Now let's go and look at the policy. We are going to finish the cash budget, at least. Look at the policy on variable overhead. Look at it here, please. Variable overhead are paid 60% in the months in which they are incurred. 40% and 40% in the following month. Is that clear enough?
Yes, sir.
Look at the next working. In the month of January, we incurred 430,000. But we are only going to pay 60% in January, 40% the following month after January. Please compute 60% of 430.
%60 of 430. That's 258,000.
Look at your screen. Variable overhead paid in cash in January 60%, 258,000. The balance to be paid in February, 40% of 430 to be paid in February. That will give you 172. Look at it. The balance of this money paid in February. You now go to February overhead incurred. In February, we incurred 369,000. In that month, we are going to pay 60%. Please compute. Please compute 60% of 369.
221,400.
That was why we placed it in February. Balance to be paid following month after February, 40%. If you compute, it's going to give you 147,600. Then the month of March, we incurred 423,000. We are going to pay 60% in March. Compute. 60% of 423. What do you have?
253,800.
Now the figure you have here. Balance to be paid following month after March. That will take us to April. We are not interested in April budget. We now have for January. That means overhead incurred in December. Balance will be paid in January. Is that not, please?
Yes, sir.
That overhead, variable overhead for December, 40% balance will be paid in January 2015. If you go check the question, examiner says, please look at this. At 1st January 2015, creditors for variable and fixed overhead are estimated at 92,000 and 150,000. That means you have been given variable overhead and fixed overhead at the start of January. Variable is 92,000. Fixed is 150. I can come here. The figure here is 92,000. That is the actual amount paid in cash. In the month of January, the cash payments for variable overhead, 350,000. In the month of February, the cash payment is 393,400. This is the cash payment. This is what will go to your cash flow statement. Look at it. Cash paid in variable overhead payments. 1, 2, 3. The last aspect is fixed overhead. What is the fixed overhead payment? Go and look at the question. Paragraph 1 says, look at paragraph 1. Monthly fixed overhead. Monthly, every month. Our monthly fixed overhead is 200,000 naira. That means in the month of January, 200,000. In the month of February, 200,000. In the month of March, 200,000. Look at paragraph 2 or paragraph 3. Look at it, please. Fixed overhead include 25,000 naira of depreciation and fixed overhead are paid 1 month after the cost is incurred. That fixed overhead includes depreciation of 25,000. Depreciation is a non-cash flow. That cannot be on the balance, on your cash flow statements, on your cash budget. Look at the working year. Amount here is 200,000. Out of this money, you have depreciation 25,000. That means your fixed overhead in cash monthly 175. The amount for January fixed overhead cash 175. The amount for February 175. The amount for March 175. Examiner says these overhead are paid 1 month after. That means the fixed overhead for January will be paid in February. The fixed overhead for February will be paid in March. The fixed overhead for March will be paid in April. Go back to your budget. Look at it. The fixed overhead for January, 175,000 cash to be paid in February. The fixed overhead for February, 175,000 cash to be paid in March. What about January? That means the fixed overhead for December will be paid in what? January. What is the fixed overhead for December? It was incurred in December. Look at the question. At 1st January 2015, creditors for variable and fixed overhead are estimated at 92,000 and 150,000 respectively. That is the overhead for December 2014. To be paid 1 month later. That will be paid in January. That was why it was carried as creditors. You come here. We have 150,000 here. If you want to get your total cash outflow, add raw material payments plus labor payments plus variable overhead payments plus fixed overhead payments. That will give you the total outflow. Compute for January, February, March. You can compute for January, February, and March. The figure is not there for us. The total outflow for January, you have it. February, March. To get your net cash flow, please look at it. Cash inflow minus cash outflow. It is cash inflow minus outflow. Then your opening cash balance, that's the only figure remaining. We need to look at it. Cash balance at 1st January, 13,000. Once I put this figure here, that will be the cash balance. To get your closing balance, net cash flow plus opening cash balance, that will give you your closing cash balance for January. The closing cash balance for January becomes opening cash balance for February. The closing cash balance for February becomes opening for March. Net cash flow plus opening cash balance. That will give you your closing cash balance. You are done with your cash budgets. You are done with your cash budgets. Honestly, the objective is to, but we cannot touch this. You may go through it. The last aspect is profit or loss budget. If you are to prepare profit or loss budget, you are going to prepare using Akura concept. Once your sales has been made, whether you collect cash or not, you must recognize it. This is the cash. Your profit and loss budget. All right. We have tried to to finish this today, but it's unfortunate we have to continue next week. One more class on budget. All right, the class is even so few. Please, we are going to share the Excel. Please study the Excel plus the working notes. Any question, please? All right, let's have a blessed evening.
Thank you, sir.
So please, if you have any question, please reach out to me. Although for students, the number is even reducing now. They want to go and start reading. We can't stop you from doing that. But we also advise that try and finish the class. All right, good night and remain blessed. I'll be checking out.